Revenue is up 18.4%, but finance costs have surged by an uncomfortable 20.8% in the same reporting period. If you are relying on this counter to fund your CPF retirement distributions, that parallel escalation in debt cost is the only friction point that matters. Here is the forensic audit revealing what the management presentation obscured about your actual dividend sustainability. This is one of those pieces where I had to run the data twice because I did not believe it the first time. On paper, the growth looks flawless, but the moment you audit the debt structure, the margin for error is much thinner than management lets on. Management is aggressively promoting a gross revenue figure of 120.956 million Singapore dollars for the first quarter of 2026. That headline looks impressive, until you look at the escalating cost management chose not to highlight. Finance costs rose to 15.053 million Singapore dollars. That is a 20.8% surge that actually outpaces the 18.4% revenue growth. For an income investor, that parallel escalation in debt cost is the only friction point that matters. We need to audit these numbers beyond the AI hype because the income-weighted average lease expiry is shrinking while the interest expense is climbing. The headline numbers show gross revenue hitting 120.956 million Singapore dollars, up 18.4% from 102.179 million in the same quarter last year. Net property income also looks strong, coming in at 105.173 million Singapore dollars, a 19.4% year-on-year increase. Distributable income followed suit, rising to 74.613 million from 61.839 million. Even property expenses saw a 12.2% rise, hitting 15.783 million Singapore dollars. On the surface, the machine is humming along, but we have to look at what brought this growth. The raw distribution per unit is 2.833 cents, which is a 13.2% year-on-year increase from 2.503 cents. For a heartland investor holding exactly 10,000 units in their supplemental retirement scheme account, that translates to a reliable $283.30 quarterly payout. But we must aggressively question how they engineered this uplift. This growth is largely purchased, not organic, driven by the Tokyo Data Center 3 acquisition and the consolidation of Singapore 3 and 4. When you buy growth using the balance sheet, the quality of that debt becomes more important than the rent itself. Let us apply basic Kopitiam logic to these figures. Buying a new asset to boost your gross revenue is exactly like a hawker taking out a massive bank loan to open a second stall in a different neighborhood. Yes, your total daily takings will go up. Your revenue looks bigger on paper, but you must immediately audit the loan first. Finance costs hit 15.053 million Singapore dollars, that 20.8% jump. While the average cost of debt dropped by 40 basis points to 2.6% using Japanese yen and Singapore dollar loans, you are still carrying a much larger total debt load to generate that extra income. Now we strip down the balance sheet for a forensic audit. Aggregate leverage sits at exactly 35.1%, which officially breaches my strict 35.0% forensic ceiling for a pure-play digital infrastructure REIT. Historically, this counter enjoyed a pristine gearing profile of around 32% over the last 5 years. They are down 20 basis points from December, but they are still wearing a much heavier backpack than their own historical standard. Comparing them to Mapletree Industrial Trust at 37.2% is a mistake, because Mapletree is diversified. Keppel DC has massive tenant concentration, which makes this 35.1% level a significant forensic red flag. The interest coverage ratio reveals a hidden risk when we apply a stress test. Today, the ratio stands at 7.2 times, down from 7.5 times, and technically it passes our 4.0 times forensic floor. But look at the margin of safety on the unhedged portion of their debt. If the market triggers a 100 basis points rate hike, that interest coverage ratio drops severely to 5.3 times. Still above our floor, but the compression happens incredibly fast. This shrinking margin means the REIT has less room to breathe if the macro environment stays uncooperative. The 2.4 billion Singapore dollar debt breakdown shows a very specific currency strategy. Japanese yen makes up 39.6% of the debt, followed by Singapore dollars at 29.7% and euros at 21.1%. Approximately 84.8% is fixed or hedged, which mitigates the immediate rate shock. But 8.5% of this total debt matures in 2026. That nearest refinancing exposure is dangerously close. They have about 550 million Singapore dollars in headroom before hitting their internal 40% ceiling, and they are using a 71% natural hedge on overseas portfolios to stay neutral. Here is the loudest number in the entire presentation, the one management stayed silent on. The weighted average lease expiry by lettable area looks comfortable at 6.5 years, but the weighted average lease expiry by actual rental income collapses to just 4.6 years. This is because fully fitted colocation assets generate 73.3% of the total rental income on brutally short 3-year contracts. When your highest earning assets are turning over every 3 years, you are on a constant treadmill of renewal risk. Management's silence on this income gap is a clear signal that the operational intensity of this portfolio is rising. The operational audit shows a portfolio occupancy of 95.6%, a slight dip from 95.8% in the prior quarter. With 25 data centers across 10 countries, the geographic reach is impressive. But Singapore remains the absolute beating heart of the portfolio. This concentration is their greatest moat because of Singapore's connectivity. It is also their greatest single point of failure. If the local market shifts or power constraints tighten, the impact on the bottom line is immediate because there is nowhere else for that concentrated value to hide. When you invest here, you are essentially betting on a few global tech monopolies. A single Fortune 500 hyperscaler controls an astonishing 42.8% of the total rental income. Another separate tenant takes up 9.5%, while IT services and telecoms make up about 13% each. This is not a diversified property portfolio in the traditional sense. It is a direct proxy for the global technology giants. If your top tenant decides to move their workload or build their own facility, nearly half of your rental income could vanish in a single lease expiry cycle. Some individual assets are currently bleeding cash flow and the clocks are ticking. Keppel DC Singapore 1 is sitting at a 50.9% occupancy rate, a painful vacancy hole that management must fill. In the United Kingdom, the Cardiff data center has a weighted average lease expiry of just 0.2 years that is immediate vacancy risk. Even the London GV7 facility has a weighted average lease expiry under 1 year at 0.9 years. These are not distant problems. These are immediate operational hurdles that require resolution now to prevent a direct hit to your distributions. We also need to look at who bears the actual operational costs. On a triple net lease structure, like we see with DC1, the tenant pays the rent plus all outgoings, maintenance, taxes, which insulates the REIT from inflation. In a co-location arrangement, the REIT bears the massive cost of running the facility, including the power and cooling. This structural split is exactly why property expenses rose 12.2% this quarter. As more of the portfolio shifts toward co-location to capture AI demand, the REIT takes on more of the operational headache and the cost volatility. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. Global data center demand is projected to jump from 82 gigawatts in 2025 to 219 gigawatts by 2030. AI inference is expected to take up 42.6% of that share. But this narrative is not frictionless money. Achieving these numbers requires massive, continuous capital expenditure and upgrades to existing infrastructure that will pressure the balance sheet for years. These growth targets come with real environmental, social, and governance costs. Management is targeting a 50% reduction in Scope 1 and Scope 2 emissions by 2035 against the 2025 baseline. They are also aiming for green certifications for all fully fitted co-location assets by 2030. To fund this, they have already obtained 608 million Singapore dollars in green financing. Being green is necessary to attract top-tier tech tenants, but these commitments represent a mandatory reinvestment of capital that could otherwise go toward distributions. You have to audit whether these green targets are protecting value or just adding another layer of expense. The corporate structure tells you exactly who gets paid first. The REIT manager is 100% owned by Keppel, while institutional and public investors hold 87.7% of the units. Keppel themselves retain a 17.9% stake. The massive global pivot to 219 gigawatts will require billions in fresh capital. If the REIT cannot fund its share through organic earnings, they will inevitably return to unit holders for equity fundraising. For a retail investor, that means your distributions could be diluted just to keep the growth narrative alive. We need a valuation reality check, because there is a gap between paper value and cash reality. The units are trading at around 2 Singapore dollars and 38 cents, while the stated assets under management sit at 6.3 billion Singapore dollars. Management is using platform-level capital solutions like joint ventures and private infrastructure funds, which can actively inflate paper valuations in the private market. Do not mistake private market valuation expansion for public market dividend safety. If the private market bids up the assets, it does not necessarily mean your quarterly check is getting bigger. Think of it like the HDB-LIFT upgrade analogy. The government upgrades your block, and technically your flat's paper value rises. But unless you sell that flat, not a single extra dollar goes into your pocket for daily groceries. The REIT has a $6.3 billion valuation driven by cap rate compression. But what actually pays your bills is the 74.613 million Singapore dollars in distributable income. If that gap between paper valuation and actual cash generated keeps widening, you are looking at a classic yield trap. To keep our audit objective, we use strict forensic standards. I apply a conservative 32% stress test floor for sanctuary assets. Even if the T-bill rate is at its current level, we audit for the storm, not the sunny day. This leads to a minimum yield hurdle of 4.7%, my 3.2% floor plus a mandatory 150 basis point risk premium. If a REIT cannot clear this hurdle under stress, it does not earn a place in a high-conviction retirement portfolio. The income scorecard for this quarter is all green. Gross revenue hit 120.956 million. Property expenses were 15.783 million, and net property income reached 105.173 million. Distributable income and distribution per unit also passed, with distribution per unit growing 13.2% to 2.833 cents. On a pure income basis, management has delivered exactly what they promised. But as forensic investors, we know the income is only half the story. The health of the balance sheet is where the real bodies are buried. The gearing alert is where the real friction lives. The gearing ratio of 35.1% is a technical fail against my 35% threshold. Net debt at 2.4 billion is acceptable. The interest coverage ratio of 7.2 times is a pass, but the nearest maturity in 2026 is a fail. It is less than 12 months away. Refinancing exposure at 8.5% is technically a pass, but the combination of the gearing breach and the upcoming maturity wall means the margin for error has disappeared. As we move into the lease expiry risks, if you want to see these forensic audits the moment they hit my desk, you need to join Iggy's elite investors. My elite circle gets 0-day access to every spreadsheet and stress test before the public even knows the results are out. Link is in the description. The lease expiry cliff between 2026 and 2029, the pressure is mounting. While 53.5% of the lettable area is stable until 2031, the 35.6% expiring in the next few years is concentrated in the colocation assets. These are the assets generating the majority of the rental income. Renewing these leases in an uncooperative macro environment will require flawless execution. If management fumbles these renewals, the distributable income we saw earlier takes a direct hit. 3 forward scenarios. In the bear case, a 100 basis point rate hike combined with Cardiff vacancies could drop the interest coverage to 5.3 times and contract the distribution per unit by more than 5%. The base case assumes stable renewals with about 5% reversion and steady growth. In the bull case, AI demand absorbs the Singapore 1 vacancy, pushing occupancy above 98% and growing the distribution per unit by more than 8%. Your decision depends on which probability you assign to that 2026 debt wall. Management does have a verified track record of credibility. They acquired Tokyo Data Center 3 and executed the hyperscale pivot exactly as promised. They even managed to bring the cost of debt down to 2.6% despite the brutal macro environment. But past execution is not a guarantee of future rent collections. Having a weighted average lease expiry under 1 year in the United Kingdom is a specific operational fire that management has to put out before they can claim a clean bill of health. My insight here is that the margin for error is shrinking. The 40 basis point drop in debt costs confirms disciplined management, but the 550 million Singapore dollars in headroom buys them exactly one major hyperscale facility before they hit their 40% internal ceiling. After that, they either have to dilute your holdings through equity fundraising or the growth story stalls entirely. This is why the counter remains on my watch list until that 2026 debt refinancing wall is successfully cleared. I want to be clear before I give the final verdict. You are not here for casual tips or market hype. You are here because you want the forensic truth before you commit a single dollar of your hard-earned capital. The data shows a REIT that is performing well operationally but is being pushed to its financial limits to maintain that performance. We do not ignore the breach of the gearing ceiling just because the distribution per unit went up. We use it to calculate our margin of safety. The algorithm only sees one signal. Every forensic investor who watches these videos without subscribing remains invisible to the machine. If this analysis has helped you identify a risk or calculate a margin of safety for your own portfolio, please subscribe and share this with one person who needs to hear the data. It is not for me, it is to tell the algorithm that data-driven SGX analysis deserves a seat at the table. The bottom line is that a passing grade is not the same as a clean bill of health. The income numbers are real, and the distribution per unit growth is genuine, Management earns their grade on execution. But the 35.1% gearing breach is a forensic fact, not a rounding error. When you add the 42.8% single tenant risk and the lease expiry cluster approaching in 2026, you see a structural vulnerability that no AI tailwind can fully paper over. My forensic position is to keep this on the watch list, not to discard it. For CPF and SRS investors, the structural case for data center demand is legitimate and the balance sheet is stretched, not distressed. But I am waiting for 3 specific triggers before making any portfolio decision. The successful clearance of the 2026 maturity wall, a credible resolution for the Cardiff and GV7 vacancies, and meaningful progress in filling the 50.9% hole at Singapore 1. Keppel DC REIT is a monitor, verify, and wait situation. Do not chase the yield just because the headline looks green. Until those 3 triggers are resolved, a prudent capital allocator waits for the numbers to confirm what the narrative is promising. The AI story is great, but your retirement is funded by cash flow and balance sheet stability, not projections of gigawatt demand in 2030. The red flags were always there. For a pure-play digital REIT, crossing 35% gearing and leaning on a single tenant for nearly half your income are risks that cannot be ignored. Join Iggy's elite investors to get the 0-day actionability window on the next audit. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.